Live right now, guys.
We
Welcome
are
back to another
live.
edition of Real Talk. I have Luis Renteria and Geraldine Serrano with me. Geraldine,
Yeah,
welcome.
yeah.
Thank
Whoop,
you for having
whoop.
me.
My pleasure.
Geraldine Serrano, thank you so much for joining us. And let me just say that we are live from Cinnabar
That's
in
right.
San Jose, South San Jose. We're at the SCORE tournament. SCORE, that acronym for Santa Clara County Association of Realtors or Realtors. See, I go back and forth on that. What do you think it is,
Realtor.
Geraldine? Realtor, like nuclear, or realtor or realtor? I don't know. What do you think?
I say realtor.
Realtor, right?
Is it
Okay,
like
real O.
tomato, tomato?
Exactly. Exactly. Tomato, tomato. But thank you so much for joining us today. And
Absolutely.
today we're going to talk about something that I'm going to use the word dumb about. And I'm so happy that you're on because talk to me like a fifth grader because I don't know about this cost segregation stuff. And I get customers, clients that ask me about it, and all I say, whatever I see on TikTok. And what I see on TikTok is dumb. Okay. So you're a professional, you've been doing it forever, and we are excited to hear from you.
Oh, great. Well, thanks for having me. I've been in my industry for over 10 years. And until today, most people I meet have never heard about cost segregation, which is unfortunate. Um, the story I like to tell is this happens all the time. I'll have a real estate investor call me saying that he has his tax return, or he or she has their tax return in their hand, ready to sign and mail to the IRS along with a check for, it could be 50,000, 100,000, and someone told them, or they found me online, or they saw me being interviewed, and they'll call me to see if there's something I can do where they don't have to pay the IRS, and I'll ask them to send me some information on their investment properties, and most of the time my team and I will look at it, and I will tell them if they don't want to, pay the IRS a single penny, they don't. And they say, great, how are we going to do that? And I say, well, when you own investment property, you get depreciation.
I know that's a
In the
huge,
shirt.
that's like a tax shirt. I love the shirt too.
Yeah, fully depreciated but still in use. So I tell them that every year they get an annual non-cash tax deduction, right? That's huge. A tax deduction called depreciation. And they get
Mm-hmm.
that every year for a certain amount of time. For residential properties, they get it for 27 and a half years. And for commercial properties, they get it for 39 years. So what I tell them is the depreciation that they got from their rental property or properties still left them
Mm-hmm.
owing,
Mm-hmm.
let's say 100,000. So I'll tell them what we need to do is we need to squeeze out more depreciation from their investment property to wipe out what how much they owe in taxes. So I tell them the way we do that is we do that with a tax strategy called cost segregation. So we'll do a
Okay.
cost segregation study on the building. You get depreciation from the building, not the land. Land's not depreciable.
Right.
So the cost segregation study, what it does is it's a detailed engineering report on the building. So it literally breaks out that building into every single component that was used to construct it, right? Foundation, the four walls, roof, windows, electrical, plumbing. And it identifies all the assets inside and outside the building that can be
Wow.
depreciated faster. So
Mhm.
inside the
So I'm sorry, Geraldine. Hold on. Before if I'm starting to get lost because I got a Windows 95 CPU here, so I got to slow it down. Um, Now I understand the 27. Did you say 27.8 years or 27 something like
27
so?
and a half.
Yeah, 27 and a half years. I understand that. Okay, I get that. So you divide it, whatever the depreciation is over the term, right? Minus the land. I sort of
Mhm.
understand that. But how do you fast forward that? What is cost segregation? I guess my question is, what is cost segregation in a nutshell? I'm a fifth grader.
Okay, so let's do this. So let's say you buy a property for $1 million,
Hmm.
right? And
Okay.
and 80% goes to the building and 20% goes to the land.
Okay.
So that means 800,000 is what you're going to take. That is what it is what's depreciable, right? And
So
you're going
that's
to
divided by 27.5 years.
right. So
Boom.
that
Gotcha.
means you're going to get 29,000 each year in a
Off the
non-cash,
top.
yeah,
Oh,
on a non-cash tax deduction that you can use to lower your tax liability, right?
Okay.
that's fantastic.
Well,
That's
let's
called, is that MICRS? Is that what they call it?
what is it?
MACRS, or is that just a straight line depreciation thing, or what
Oh,
are we talking?
that's called straight line depreciation.
Okay. Got it.
So
Okay.
a cost seg study on average can typically move anywhere from 20 to 40% of that depreciable basis into a faster depreciation schedule,
How
right?
fast? How fast?
Like, so it can move it into 5-year assets. And so inside the building, carpet, countertops, cabinets, those are all
Wow.
5-year property, right? And outside the building, we're going to find 15-year assets. Those are going to be your land improvements like asphalt and landscaping,
Hmm.
right? So when you see a study, you're going to see 3 columns. You're going to see the
Okay.
5-year assets, the 15-year assets, and everything
And
else.
then 27 and a
Right.
half.
It has to stay on that 27.5-year schedule.
This is amazing. Okay.
So let's say we were able to move 30% total out of that 800,000 into a faster depreciation schedule between the 5 and the 15-year property.
Hmm.
Then that means total you're going to get
Oh my God.
240,000 in accelerated depreciation
Hmm.
instead of that 29,000 that we mentioned earlier.
Holy smokes. That is insane.
So when I tell that story about the investor that owed 100,000, that's how we get it off of one property.
But then, but what about after 5 years? Like, you get nothing? You
Well,
get,
no, remember we only moved 30%. The 70% remained on that 27.5-year schedule. So you'll still
oh
get
my
that
Wow.
remaining 70%.
Oh my God. And if you don't have enough deductions, like many owners, then that's wasted. It's kind of wasted.
Right. So it's a time value of money play, right? If you
Oh,
could keep that $100,000 in your pocket, most investors who know about cost segregation, they're going to use it to get their next deal.
Wow. Okay, so that's amazing. So I just took out a bunch of money that I was going to pay to the IRS and took it away from my income, essentially, right? By depreciating more fully this property that I have.
Well, not more fully, right? You were just able to grab a chunk of it
and
and use
fast
it.
forward it.
Yeah, because the value of the dollar today, right, is going to be more valuable than when you use it in the future, right? Because like let's
Correct.
use that example. If you were able to pick up another investment property that's cash flowing, right, then you're going to make more with that money that you kept in your pocket than just having it distributed over time. Because
Right.
an average of investor on average holds onto a property 5 to 10 years. They're not holding it
Hmm.
on for 27 and a half, or for commercial buildings 39 years.
So when you sell the house or the building or the property, do you have to make up any of that tax? I mean, how does that work? This just sounds way too good.
So that's a great question. Whether you do cost segregation or not, you always have to deal with what's called depreciation recapture. Well, if you
Okay.
do, so we don't recommend doing a study if you're going to flip the property, right? Because then you're just going to
That's
owe more in capital gains tax, or you're going to do a 1031 exchange and defer it, right?
hmm
Well, the numbers show that if you hold on to a property for at least 2 to 3 years, you're either going to break even or you're still going to come out ahead. So it's cost segregation. So we provide an estimate at no cost so that you could do the tax planning, right? So if you're only going to hold on to it for 2 to 3 years, you can look at the numbers on the estimate, plug it into your calculation that you use, and figure out if it's going to be worth doing a cost segregation study or not. But most people, they hold on. They're, either they're going to flip it and, within a year, or they're definitely holding on to it long term, right? Because especially in today's market, I mean, it's tough, right? Because you got to find either a cash buyer, or you got to deal with the group that has to qualify for a loan and are going to pay those high interest rates, right? So, but I mean, so that's why right now you don't see a huge inventory. People are holding on to those investment properties.
Right. So if we fast forward this these deductions or this depreciation, I'm sorry, that may open up some that's going to free up some funds.
Yeah.
Oh,
So
this is
it,
incredible
so a
because
lot of
yeah, go ahead,
no.
go ahead.
What
I'll
were you
get
gonna
too
say?
excited. No, I was just gonna say, like, say on that house, say they're deducting the depreciation. If you go 27 and a half years, you have $29,000, right, in depreciation on this particular example we're talking about. Now, if they're paying $3,000, say in rent, or they're receiving $3,000 in rents, you typically, I mean, this is the way I present it. I go, look, between the property taxes and the depreciation, you're not going to, that's like a tax shelter, but make sure you talk to a tax professional because I am not that. Of course, a disclaimer, but yeah, that offsets it. Now, in this case, if you're fast forwarding that depreciation from 27 and a half years and you're taking that 30% chunk and moving it forward, like moving it to a 5 years, you said 200,000 in depreciation. Like, what do you do with that money? I mean,
Yeah, what would you do with it, Luis?
yeah.
Ramin, what
So
would you do with that kind of money?
I'd throw it back into another investment, right? Like you were talking about. So now I got $250,000 less tax liability than I had previously, and that would translate to what, 40% basically of that. So what is that going to be? 25 times four. It's like 100. It's like almost $80,000 extra income that I had that I can play with, right?
Yeah. So I mean, people, they have their different, they're going to have different ways that they could use that money, right? But a lot of the investors that I work with, they definitely, what you said, Ramin, they're going to dump it. They're going to use it to pick up another property,
Right.
right? That's cash flowing, right? That's the whole reason why that had that tax liability. And Luis, you brought up a good point. So the way it works is you take your gross, to illustrate how depreciation and accelerated depreciation is technically applied. You take your gross rental income, you deduct your expenses, right?
mhm,
Mortgage, insurance, etc. And then
Right.
you get your net rental income. From
Right.
there, you deduct the depreciation, right? So if you said you were collecting 3,000 a month, right? That's 36,000 for the year. So in that example that we gave earlier, and you get 29,000 in depreciation, you're still going to have to report 7,000 in taxable income, right? I
Right.
mean,
mhm.
that's minimal, but I mean, for a lot of my investors that own multiple properties,
Yeah, that
that
adds up.
difference, right? That positive cash flow could be bigger than just that, you know, what, that 7,000, right? So
Yep.
that's why they're reporting taxable income just on their rental properties. That's why they're reporting, if you times that by 10, that's 70,000, right?
Yeah.
Of
Yeah.
reported
So
income.
Holy smokes. So hold on. So we're able to add, as lenders, we're able to add depreciation back as effective income, a qualifying
Right.
income.
are you?
Yes.
Yeah, we are.
So so here's a good question. So I have clients that are looking for the lenders that will take the cost segregation numbers into account, and so that they can qualify for a loan. So would you guys, so that whoever's listening or will watch this video later,
What?
I mean,
What?
would you take that into account? Because those are all nationwide. I'm getting asked, investors want to find the lenders that will take that into account so they can get the financing.
Geraldine,
As
I'll
long
one
as
up you on that one. If you put 20% down as an investor, I don't care how much money you make, I can give you a loan, right? So we got some new products right now that are available. It's like the bad old days once again, but it's the good old days for investors. So 20% down, we really don't care how much money you make. It doesn't make a difference. But in general, we do add back depreciation as part of your income. So we know people take out depreciation to help them offset their costs. So we do add depreciation back in as a general rule of thumb here.
well, Geraldine, I'm pulling up the guidelines right now because I need to make sure, because this is insane. Because imagine if you can add, let's just say even $100,000 back in depreciation. We can use that divided by 12. We can use that and
That's
factor it all in, and
$8,000 a month right there.
that's just insane. That
Yeah.
is crazy.
So then what's your contact number so they know to call you?
Absolutely. Well, I
My
want your
God.
contact number on here. But actually, anybody who wants to talk to Geraldine, please comment in the comment section, and we'll make sure you have a handle on her and contact information. But that's number one. Number two, I wanted to ask you, what the heck is this bonus depreciation everybody keeps talking about? What's up with that? And tell us who and how that came about.
So let's go back to that example that we were talking about, right? If
Right.
if we were able to move 30% of that 800,000 depreciable basis into a faster depreciation schedule,
Right.
so that's total 240,000 is the total between the 5 and the 15-year property. Now let's talk about bonus depreciation. So if there was no bonus depreciation in place, what you had mentioned, Luis, is that you would get the 5-year property identified over 5 years, and you get the 15-year property over 15 years. However, with the total, when it comes to bonus depreciation, the tax laws changed in 2017 that heavily benefited the real estate investors that knew about it. It stated that if you've purchased or newly constructed a property after September 27th, 2017, and before the end of 2022, you got what's called 100% bonus depreciation. So that 240,000 that we're talking about, you had access to it immediately. You didn't have to wait 5 or 15 years. So that was huge for the people that owed that amount, that kind of, that had that type of tax liability if they've purchased or newly constructed a property in that time frame. So what happened last year, right? Now to go towards what happened in 2023, it dropped to 80%. That's still huge. Well, what happens with the remaining 20%? Then that will be spread out over 5 or 15 years. So what
Okay.
so what happened? So what happened this year? 60%.
It's going
And next
down.
year, 40%.
Right. It's going to continue to decrease by 20% each year until it hits zero in 2027. So people ask, Geraldine, when is it still a good time to buy? Well,
Amazing.
60 is better than 40 or 20 or zero.
Yeah. When I get that question, hey, is it a good time to buy a house? I say, look,
Yeah.
5 years ago is the best time to buy a house.
Yep.
Always. And if you look at the stats, think about it. Rewind that $1 million house that right now it's $1 million. Think about how much it was 5 years ago and think about how much it was 10 years ago. 2014, that same house, I can assure you is right around 450 to 550. And now it doubled.
Right.
And every 10
Geraldine,
years, they double.
how do you play into the other people who are involved in this, right? So how do you play to a 1031 person? And how do you play to my CPA? And how do you play to my other partners on my team, let's say? Where does this fit? So Luis was asking, what happens to the depreciation after I sell the house, right? So I can reclaim it, right? Recapture it, right? And that would be what, a part of the 1031 deal? How does this fit into the 1031 realm of the worlds?
So people will ask me, Geraldine, can you do a cost segregation study when you do a 1031 exchange? And the answer is absolutely. But in order to maximize the tax benefit you receive, you should do it on both the relinquished property and the new property. And the reason being is because on the old property, the study is going to be done on the remaining basis that you have on the old property, and on the
Okay.
new property, we're going to use the carry forward basis as the number that we use to do the study on the new property. Meaning, so
Wow.
like the carry forward basis, right, is calculated between the new, what you bought the new property for and what you sold the old property for, right? This all has to deal with how the capital gains tax is calculated, right? Did you make a
Mm-hmm.
profit?
Mm-hmm. I got
So
that. Yeah.
so we have to look at that number for the new property. But if you only do a cost seg on the new property, you miss the opportunity to capture what you could have got on the relinquished property. So you want to make
Wow.
sure you get the benefit of both.
So is this a really expensive venture, or how much does it cost for a cost seg?
So unfortunately for me, it's not based off of the tax savings, because if it was,
Okay.
I would be retired by now. I would be at Cinnabar golfing, 18
There you go.
holes. And I wouldn't be talking about cost seg. But unfortunately for me, it's based, we charge a flat rate, and it's based on the amount of work involved to do the report. So
Okay.
to give you an idea of what that looks like, I had a client that bought a single family home in Calistoga for over
Okay.
900,000. For a $5,000 fee, she got over 300,000 in accelerated depreciation, right? And she only had to pay
Wow.
$5,000, which is 100% tax deductible, in order to get that amount in accelerated depreciation. And she
So it's
only
not a
did this.
huge fee. That's crazy. I thought it'd be like in thousands of dollars, but we're talking under 10 for anything, pretty much, right? Unless you're living in a multi-million dollar blah blah blah. But it seems pretty reasonable. So there's no reason why somebody shouldn't contact you and get a cost seg done. And then also on top of that, bonus depreciation. And then I would assume that you have to play with my partners like Sheila Long from the 1031 and my CPAs and stuff to help me to overcome my tax burden, essentially, right? So you
Mhm.
you play an integral role with all these guys in my team, essentially.
Yes.
Yeah, I love it. And part of this NAR thing, the NAR lawsuit that we've been talking about recently, realtors have to change their game, right? And have to talk about what they bring to the table a lot. And having a partner like yourself on the team, let's say, for the buying side, it makes a huge difference when I can explain to the new person who's buying a house, hey, or an investor who's newly investing, hey, we can take a cost segmented cost seg analysis and help you to lower your carry costs and to help you with your cash flow and even help you when you sell this other property with the 1031 side to not have all these costs associated with it. So you become a very valuable piece of the puzzle essentially in this real estate game.
Yeah.
Love it. Love it.
I,
All right, cool. We
I'm
don't seem to
back.
have any questions today. You're back. What happened? I saw you
I'm
drop off,
back.
Lou.
I
I
know.
don't
He
know.
got bored
Just
with cost segregation. He doesn't want to talk about
crashed.
that anymore.
Yeah,
Honestly,
right.
cost
No,
seg is
no,
cool.
no,
I
no.
like
This
the
is
bonus
pretty cool.
depreciation a lot better. It's more fun to me. This whole taking up front a bunch of money. I dig that a little bit more.
I think it's more funner as well. It's more gooder. I like the more gooder stuff.
Very cool. And
Hey,
Geraldine,
so
let me,
so
yeah,
you know what I got out of this, Ramin and Geraldine, is that you actually need a team of professionals because you need to be able to talk to to your CPA. Everybody needs to communicate, and then you add in a 1031 exchange in there in the mix. That gets pretty complex. So it's definitely a team, and that team might cost you, five to $10,000, but you're saving 150,000. So basically, don't be cheap. It's expensive to be cheap. So that's what I got. That's my PSA.
That's what I say.
that having a team in place is the most critical thing you can do these days. And
Yeah.
realtors, if you're listening, having Geraldine on your team, when you pitch why you should be the salesperson of record on the buying side, is because you've got a person like Geraldine on your team who can actually hammer out some more money for you under this deal. So
hmm Yeah, especially if you're doing listing appointments or listing presentations and even the buyer presentations, like, hey, so let me take a look at all this. You know what? You need to talk to this professional and this. You got to do a little check mark because I'm not just going to put a freaking sign on the house and put it on the MLS and just have AI, have ChatGPT do the description. So now it's even easier. No, I got a group of professionals. I got a network. You're getting my network of professionals that are going to save you hundreds of thousands, hundreds, if not thousands, if not hundreds of thousands. There.
There you go.
So
And then Geraldine's information is right here below. It's scrolling at the bottom. Please hit her up if you need her email as well. What's your email address, Geraldine?
It's geraldine.serrano@specialtytaxgroup.com.
STG. Awesome. Okay,
TG.
very cool. Geraldine, you're awesome. I would like to have you back,
this is
and I'd like to
awesome.
have you, along with Sheila Long, our 1031 person,
Yes,
have a
yes. I was
conversation.
thinking that
And
same
I'd like to
thing.
also bring a CPA in and have you guys roundtable this thing. Okay, so I'll bring a tax advisor, and I'll bring Sheila Long, and I'll bring my bonus depreciation / cost seg person, which is you. You're amazing, and we'll just have a conversation. How's that sound?
Sounds great. Love to be back.
Okay, awesome. Geraldine,
Yup,
thank
I
you so much for
agree.
coming on. Really had fun
Thanks
today.
for
It was
having me.
great.
Geraldine, thank you. It was so nice to meet you.
Yeah, nice to meet you, Luis. All right, thank you.
All
All right,
right.
we'll catch you on the next one. Thanks, Geraldine.
Until
Appreciate it.
next time. Thanks everybody for
See ya.
joining us.
Thank you.
Thanks. Bye.
And we're almost there, guys. I'm just lagging on this computer.